In this video, let me give you a breakdown of the recent economic analysis released by Fannie Mae. The short version of this story is, start saving money. Because these experts are predicting an upcoming mild recession in 2023. Just like the mild inflation that they predicted in 2022, and is also happening right now. Seriously, early this year, they predicted about what can happen to inflation, and told us that they expect the inflation would average about 7%. So let's go ahead and see how's their prediction going so far. The Consumer Price Index, or CPI, which measures inflation, resulted at 7.5% for January, at 7.9% for February, and 8.5% at March, for an average of 8% for the first quarter this year. This shows a huge difference from their first predictions of 7%. In today's video, I'm going breakdown for you what's their prediction for interest rates, real estate, stocks, NFTs, and crypto, and how all this can affect us, because maybe they are right that we are really in for an upcoming recession, but maybe based only on their track records, not actually about how bad things could get. So without further ado, let's get right into it. Just a huge heads up, it may sound confusing, it is because it is, but no worries, I'll do my best to keep things simple. Let me start with what can potentially happen, by going back at the past 10 years every time the stock market does something incredibly unexpected. On average, people make money for 10 years in the stock market, and people also lose money for 10 years. This cycle happens over and over. Just look at the years between from 1989 until 1999, and let's use them as an example. Amazing time to be an investor, right? I wasn't even born yet, so no investing for me at that time. At the years of 2000 and 2011, the stock market didn't make money, but actually lost 0.13, which may not be a lot of money to lose, but if you look at it like in a scenario where you invest $1,000 one day, forget about it, then after you check on it 10 years later to see that your $1,000 is actually worth $998.70. Could be very devastating, right? You would be discouraged to learn that 10 years of progress didn't amount to any worth at all. Stock market isn't all that great then, right? But if you decide to still hold on to that money for another 10 years of your life, then you would have made 13.2%. Basically, at the end of the day, stock market get and stock market give. Now, let's look into another 10 years between 2022 and 2032. Stock market can end up losing money potentially, or stay flat. This is where this story starts, and exactly how a recession in the stock market can happen. Let's address this first. Let's talk about Chair of the Federal Reserve, Jerome Powell's job from the start is to safe landing, or soft transition between cooling everything, in every market down, without the need to increasing the rate of unemployment. In simpler terms, we need to slow everything down without causing people to lose jobs, and as of now inflation is signaling to the Federal Reserve that everything in life is getting too expensive, faster than normal, and expected. Therefore the Fed's response with a more tight monetary policy by increasing interest rates is threatening our soft landing without the cause of an economic recession. Because based on history, soft landings is almost impossible with the extreme rarity. Between 1955 to 2019 we had 10 hard landings so far, meaning most of the time we tried to control and slow inflation by increasing rates, we get recessions. Things are about to get heavy moving forward. If you don't understand some of this stuff, you're not alone, because it took me forever too. But don't fret, I will tie everything together and make sense of all of it. The technical term is the end of monetary expansion cycle, and here's the signs we're close to the end of it. As of right now, let's face it, things are actually looking bad, if it isn't obvious yet. About 81% of the US is thinking and worried that a recession is inevitable, with experts such as a head economist at Harvard believes that recession is actually here with us already. The top recession indicator, the Treasury's yield curve, has already showed some confirmations about this disaster. Personally, I'm preparing to all this as by investing into alternatives and diversify my portfolio as best as I could, and it's doing a very good job for me. Here are the 3 main key takeaways that you can take advantage of to help figure out that we are in the stage where this repeating 10-year cycle is coming to an end. First key is unemployment rate. Here is where you can see the employment rate, as confirmed by experts, in an economy where our unemployment rate is identical or equal to the non-accelerating inflation rate of unemployment, NEHRU or NERU. I probably sounded insane there. That's because in making this video, I haven't even heard of the acronym NERU as it's applied to economics. Kind of like the physics of dark matter. Physicists people think that 85% of the universe is made up of stuff called dark matter, but as of now, they haven't proven it to conclude such fact. But there are strong signs and suggestions that it does exist, and it's exactly similar with NERU but in economics. Interesting note about NERU, And by the way, as mentioned in this research article that I'm showing you, I'm not making any of this stuff up. This shows that it's not something you can measure, and no index one can show you that says it exists. But it does exist, and the budget of congressional office and other branches of the government measures it and calculates it when thinking about our economy. And here's kind of how it exactly works. When the central bank sees a major movement to the wage growth, it responds by increasing the rates to slow everything down. But what happens when it does that is it comes at the cost of producing unemployment rates, and if unemployment goes beyond this invisible narrow line, that's where an unexpected neighbor comes, and that neighbor is recession. No, I'm not crazy, I'm sure of it. Just check this chart out. This here is the wage line, and right here is the unemployment line. The goal for us is get this wage line down, which so high without affecting the unemployment line, which we won't want to go up. But, just like in the past, when wages go up, we tried to cool them down, and the cool down comes with unemployment rate going up. And when this unemployment line breaks, above the invisible narrow line, it's almost always where recession comes around, which is where these gray bits right here, marking the end of the monetary expansion cycle. The second sign, and way to measure if we're at the end of monetary expansion cycle, is of course, the rate of inflation. I know I don't have to preach all day to anyone at all about why inflation is getting worse, and worse every month the CPI data gets released. We are breaking multi-decade record highs. Every single month is higher than the month prior, and that's the sign we are at the end of this cycle. The third way to know is how the Federal Reserve responds to all of these problems. Just like the old saying, don't fight the Fed, and the task they need to accomplish right now is to slow us down and cool everything down. And that's the third sign we are at the end of this expansion cycle. Just check this chart, which measures the interest rates or federal fund rate against wage growth. Right now, we're supposed to be in lockstep, as when the wages go up, the Fed also catches up and increases the rates to help slow us and cool down everything. But see here how much have gone up wages recently, and how the Fed is not making a move at all. The Fed need to catch up, and fast. These are just some of the things that we can use to tell that we are at the end of the monetary expansion cycle. This is where the research article goes into a darker turn, and shows that it is why they predict the recession is highly possible in 2023. And the question we have is, how do they know why 2023 specifically, not this year, not 2024, not 2050 or so on? And this is where you can tell the biggest reason is economist experts estimate about 12 to 24 months for monetary policy to really make an impact in the real economy. This makes total sense, because if you look back in 2020, we dropped the rates to zero to stimulate the economy. But we didn't really feel the consequences such as inflation until this year in 2022. The question now is, how bad will all this recession get, and what can you do about it? If you're young, it won't matter for you because you have the advantage of time to wait it out and wait for the next 10-year period where you can make money. So your best course based on history is to do nothing and continue investing and growing your assets. But if you're older, you may not have the luxury of another decade to wait for a stock market recovery, in which case is very different. And if it was my parents, and I'm talking to them about all this, I will ask them to consider bonds. I-bond are some of the safest investments because they are government bonds, and as of now, the I-bond is yielding 7.1% per year, which is very amazing, and per 6 months, their interest rate adjusts and it's pegged to the CPI, which is the thing that measures inflation, and they should adjust their interest rate to 9.6 by this May. Which is an insanely amazing return. That's how much you can expect in a good year from the stock market. So I-bonds might be perfect for someone who doesn't want to keep their wealth in cash, since you know inflation is going to eat all its purchasing power away, but at the same time, doesn't have another 10 years to risk with the volatility in the stock market. This video is not exactly scientific, and it's more interpretative art. You might conclude something different, which also why economists disagree with each other all the time, despite looking at the same data together. Some of them can look at the data and say, this is how we know recession is coming, and the other side says, you're taking a bunch of things that happen to correlate things out and draw a conclusion to predict the future, but it's already happened. The past doesn't predict the future. Both sides are neither wrong or right. It's all just different perspective. My point of view here is the more I understand the complexity of economy, the more my investing decision becomes informed, way better than be driven by emotions such as fear or greed alone, right? Which won't really help our investing goals. Hopefully this helps you be more informed. Thank you so much for watching.